A pen is placed over a firm's financial position and performance. Several numerical figures are written in bold font. Figure 5, 1 financial statements are needed to understand a firm's financial position and performance. Credit. Modification of work, Drowning by Numbers by Jorge Franganillo/Flickr. CC by 20. Chapter outline. 5.1 The income statement. 5.2 The balance sheet. 5.3 The relationship between the balance sheet and the income statement. 5.4 The statement of owner's equity. 5.5 The statement of cash flows. 5.6 Operating cash flow and free cash flow to the firm, FCFF. 5.7 Common size statements. 5.8 Reporting financial activity. People say that accounting is the language of business. Using the language of business, accountants are able to communicate the financial performance and health of a firm via 4 key financial statements. These statements are the income statement, balance sheet, statement of owner's equity, and statement of cash flows. Each statement provides different insights into a firm's performance and financial health. Though some users may favor one or two statements over another, they are best used together to get a full picture. In this chapter, you'll be introduced to a firm called Clear Lake Sporting Goods. Clear Lake Sporting Goods is a small merchandising company, a company that buys finished goods and sells them to consumers, that sells hunting and fishing gear. It needs financial statements to understand its profitability and current financial position, manage cash flow, and communicate its finances to outside parties like investors, governing bodies, and lenders. We will walk through each financial statement, its components, how they are connected, and how financial statement users understand each one. Learning outcomes. By the end of this section, you will be able to outline the purpose and importance of the income statement, identify the structure and key elements of the income statement, discuss the use of EBITDA as a measure of a company's profit. Financial information flows from one financial statement to the next. Thus, the statements are prepared in a specific order. The first statement prepared is the income statement. Functionality of the income statement. The income statement shows a firm's performance over a specific period of time. The statement helps financial statement users understand the sales generated during the period and the expenses incurred to generate those sales. If the expenses are smaller than the sales, the net result is profitability, or net income, rather than a net loss. Breaking the income statement down into smaller pieces provides a more transparent view of the firm's performance, allowing users to see more clearly what areas of the business incurred expenses. This is helpful to management in driving improvements and to outside users in assessing performance. Sales and gross profit. The first section of the income statement begins with sales. Though financial statements are required to follow a certain format, account names can differ slightly from one firm to another. You may see the first line, often referred to as the top line, called sales, sales revenue, revenue, service revenues, and other similar titles. All of these titles are meant to reflect the sales generated by selling product to customers in the day-to-day business. On Clear Lake's income statement, in Figure 5.2, we see its top line referred to as sales. Income from items that aren't common to the firm's day-to-day business are reported as gains and losses, and they are reported further down in the income statement rather than at the top line with its regular, core business activities. This is to ensure that anomalies like selling a machine or a loss on retiring a bond don't mislead financial statement users as to the general performance of the firm and impact their assumptions of future results. Firms report their sales and any reductions to sales separately on the income statement. They begin with gross sales, which includes all sales to customers. Clear Lake reported gross sales of $105,000 last year and $126,000 this year. The next line is sales returns and allowances, which is deducted from gross sales in order to find net sales. Clear Lake's sales returns and allowances were $5,000 and $6,000 respectively, leaving the company with net sales of $100,000 and $120,000 respectively. 105, 000 minus $5, 000 and 126, 000 minus $6, 000. 5.1. Next, the cost of goods sold, COGS, is deducted from net sales in order to arrive at gross profit. It is customary to refer to sales minus COGS as gross profit because gross margin equals gross profit sales. Cost of goods sold includes the costs directly involved in making the product that was sold during the period. Common examples of costs included in cost of goods sold include direct labor, direct materials, and the overhead assigned to the product in production. For a service business, this would include its direct labor and any materials used to deliver its services. For a retail firm like Clear Lake Sporting Goods, this would include the costs of all the goods it purchased for resale. Clear Lake's COGS is seen at $50,000 and $60,000 for the prior and current years. Note that different types of companies will have different types of costs deducted in their cost of goods section. Clear Lake Sporting Goods is a retailer or merchandiser that buys goods to resell. Their cost of goods includes the cost of goods they purchase to resell. In the link to learning, you will explore Apple, a technology manufacturer. Their cost of goods would include the cost to manufacture the goods they sell. Another type of firm is a service firm. A law office, for example, would include primarily the cost of labor in their cost of services. Gross profit is a reflection of how profitable the firm's performance was in its core business function. It includes only the core business and direct costs of performing that business. If the company were a shoe company, gross profit would show how profitable the company was in simply making the shoes it sold. If it were a bakery, gross profit would show how profitable the company was in simply baking the goods it sold. Gross profit shows financial statement users how effective the business is at generating top-line profits on their core business function. It does not reflect the performance of other areas of the firm, such as other operating costs, to support the direct production process, indirect costs, and financing. For Clear Lake Sporting Goods, we see its gross profit in Figure 5.2. The company earned $50,000 of gross profit, 100,000, 50,000, the prior year, and $60,000 in the current year, 120,000, 60,000. Comparative year-end income statements for Clear Lake Sporting Goods through gross profits for the prior and current years. Gross sales, sales returns and allowances, net sales, cost of goods sold, and gross profit are all included on this statement. Net sales are calculated for each year by subtracting sales and returns allowances from gross sales. Gross profit was calculated for each year by subtracting the cost of goods sold from the net sales figure. Figure 5.2 Income statement through gross profit line. Link to learning. Gross profit. Visit the Apple Inc. Annual Report for 2020 and locate the income statement. It begins on page 31. Review gross sales, sales returns and allowances, and net sales for the last few years. What can you learn about the company's recent performance in the area of sales? Is the gross sales line improving? How about the sales returns and allowances line? Has it improved or declined or simply changed incrementally with gross sales? Review the firm's gross profit for the past few years. Has it improved or declined? Consider the company's improvement or decline in gross sales as compared to the improvement or decline in gross profit. Does it reflect any change in performance over time, earning more or less gross profit on its gross sales? Income from operations. Gross profit is a very helpful measure, but it is only the first of several provided by the income statement. After gross profit is calculated, other operating expenses are deducted in order to calculate the firm's income from operations, also commonly called operating income. Common operating costs found in this section include building rent and utilities, property taxes, wages and salaries, and other overhead costs. In Figure 5.3, we can see Clear Lake's operating expenses. To sell its hunting and fishing equipment in the current year, Clear Lake Sporting Goods paid rent for its building, $5,500, and utilities for its retail and warehouse spaces, $2,500. Recorded depreciation on equipment, buildings and store furnishings, shelves, racks, etc., $3,600, and paid salaries to its indirect employees in accounting, purchasing, and human resources, $5,400. The company's operating expenses are deducted from gross profit to arrive at operating income. 60, 000 minus 5, 500 minus 3, 600 minus 5, 400 minus 2, 500 equals $43, 000. 52. While gross profit reflects only how profitable the firm was in making its core product, operating income reflects how profitable the firm's daily operations were as a whole. This still does not include other miscellaneous items outside the scope of a firm's normal business. Just as the name implies, it shows income from the core operations of the firm. Comparative year-end income statements for Clear Lake Sporting Goods through operating income for the prior and current years. Rent, depreciation, salary, and utility expenses have been added to the statement. Operating income is calculated by subtracting these expenses from gross profit. Figure 5.3 income statement through income from operations. We can see that the company was able to generate 20,000, 120,000 minus $100,000 more in net sales in the current year than the prior year. However, it only generated 10,000, 60,000 minus $50,000 in gross profit and 5,000, 43,000 minus $38,000 of additional operating income. Further investigation shows that while net sales increased, so did the direct costs of its goods, COGS, and its operating expenses. We will further explore how to assess each of these expenses later in the chapter using common size analysis. Common size analysis reflects each element of a financial statement as a percentage of the base. In the case of the income statement, the base is net sales. Here we would see that COGS was 50% of net sales in both the current 60,000/$120,000 and prior year 50,000/$100,000, indicating there wasn't any significant change in performance we could detect from the information provided in the income statement. Link to learning. Operating expenses. Visit the Apple Inc. Annual Report for 2020 and locate the company's income statement. The income statement begins on page 31. Review Apple's operating income for the last few years. Has it improved or declined? Does this fall in line with your expectations based on your previous review of the company's net sales and gross profit? Based on the improvement or decline in operating income, review Apple's operating expenses to investigate. Have any of the operating expenses changed significantly? How did that impact the company's operating income? What might it tell you about the company's performance? Net income. Finally, we move on to net income, or what is commonly referred to as the bottom line. Net income, or loss, reflects the net impact of all financial transactions for the firm, including those that are caused by events outside the normal course of business. The most common items deducted from operating income to arrive at net income include interest expense, gains, losses, and income tax expense. Remember, gains and losses are those that result from unusual transactions outside the normal course of business. Examples include selling a piece of old equipment or a loss on retiring debt. We can see in Figure 5.4 that Clear Lake Sporting Goods has outstanding debt, so it incurred interest expense of $2,000 in the current year and $3,000 the prior year. Since it recorded net income, not a loss, it must also record income tax expense of $6,000 in the current and $5,000 in the prior year. Comparative year-end income statements for Clear Lake Sporting Goods through net income for the previous year and current year. Interest and income tax expenses are deducted from the operating income to calculate the net income for Clear Lake Sporting Goods. The figures for depreciation expense, interest expense, income tax expense, and net income are highlighted. Figure 5.4 Comparative Year-End Income Statement. EBITDA, earnings before interest, taxes, depreciation, and amortization. Now that we have a full income statement, we can look at another commonly used measure of financial performance called EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Amortization is similar to depreciation. It is the spreading of the cost of an intangible asset over the course of its useful life. Intangible assets are long-term assets that lack physical substance, such as patents and copyrights. Since EBITDA removes the effects of non-cash items from the net income equation, it is considered a useful measure in assessing the cash flows provided by operating activities. We will assess cash flows using the statement of cash flows and various other cash flow measures later in this chapter as well. As shown in Figure 5. 5. Clear Lake Sporting Goods. EBITDA in the prior year was EBITDA equals net income plus interest, plus taxes, plus depreciation, plus amortization. 40,500 equals $30, 000 plus $3, 000 plus $5, 000 plus $2, 500. 5. 3. And in the current year was 46,600 equals $35, 000 plus $2, 000 plus $6, 000 plus $3, 600. 5. 4. Full comparative year-end income statement for Clear Lake Sporting Goods for the prior and current years. The EBITDA for Clear Lake Sporting Goods can be calculated using information in this figure. As shown in Figure 5. 5. Clear Lake Sporting Goods EBITDA in the prior year was $40,500. This is calculated by adding the interest expense, $3,000, income tax expense, $5,000, and depreciation expense, $2,500, to the net income, $30,000. The EBITDA for current year was $46,600. This is calculated by adding the interest expense, $2,000, income tax expense, $6,000, and depreciation expense, $3,600, to the net income, $35,000. Figure 5.5 EBITDA, earnings before interest, taxes, depreciation, and amortization. Think it through. Net income. Visit the Apple, Inc. annual report for 2020 and locate the company's income statement. The income statement begins on page 31. Review net income for the last few years. Has it improved or declined? Does this fall in line with your expectations based on your previous review of the company's operating income? Solution. Net income improved in the current year over last year, but declined from 2018 to 2019. From $59,531 to $55,256. Apple's EBITDA in 2020 was $108.89. Amounts are in millions. Learning outcomes. By the end of this section, you will be able to outline the purpose and importance of the balance sheet, identify the structure and key elements of the balance sheet, the accounting equation, and the classified balance sheet. Recall that the income statement shows the performance of a firm over the course of time. The classified balance sheet shows the financial state of a company as of a specific point in time. It is a key distinction between the two statements. The classified balance sheet is prepared in sections that align with the accounting equation. Remember, the accounting equation reflects the assets, items owned by the organization, and how they were obtained by incurring liabilities or provided by owners. Liabilities are debts owed to other parties. Stated differently, every asset has a claim against it, by creditors and/or owners. Assets equals liabilities plus owner's equity. 5.5. The classified balance sheet is thus broken down into three sections: assets, liabilities, and owner's equity. If prepared correctly, the total assets on the balance sheet equals the total liabilities and owner's equity sections of the balance sheet. The classified balance sheet is considered or termed classified when the assets and liabilities within the balance sheet are grouped into even smaller sections. Current and non-current, see Figure 5.6. Both assets and liabilities are broken down on the balance sheet into current and non-current classifications in order to provide more detail and transparency, as well as abide by the convention of reporting in descending order of liquidity. Current assets are those that can be used or converted to cash within a year. Common examples of current assets include cash, inventory, accounts receivable, and short-term investments. Assets that will be in use longer than a year are considered non-current. Common examples of non-current assets include notes receivable, machinery and equipment, buildings, and land. Just as we noted a few key differences in the income statements based on the type of firm, you may also notice a few slight differences in the balance sheet depending on the firm type. Clear Lake Sporting Goods is a retailer. Thus, you will see that their inventory for resale on their balance sheet is simply called inventory. This is the goods they have purchased for resale but have not yet sold. A manufacturer, like Apple Inc. In the link to learning sections, we'll have a variety of inventory types including raw materials, work in progress, and finished goods inventory. These represent the various states of the inventory: ready to use, partially complete, and fully completed product. A service firm, on the other hand, may not have inventory at all. If it does, it may be simple goods it uses to help deliver its service. For example, a cleaning company may keep an inventory of cleaning supplies. Graphical representation of the accounting equation of Clear Lake Sporting Goods. It shows assets as well as liabilities as current and non-current. All assets equal the sum of liabilities and owner's equity. Figure 5.6 Graphical representation of the accounting equation. Both assets and liabilities are categorized as current and non-current. Clear Lake Sporting Goods has cash, accounts receivable, inventory, short-term investments, and equipment. It rents its facilities, so it has no buildings on its balance sheets. Of all its assets, only the equipment is long-term. The assets section for Clear Lake's classified balance sheet is shown in Figure 5.7. Comparative year-end balance sheet for Clear Lake Sporting Goods showing asset section of classified balance sheet for the previous year and current year. Its current assets are cash, accounts receivable, inventory, and short-term investments. Its non-current assets are equipment. The total assets for the year are calculated by adding the value of the current and non-current assets together. Figure 5.7 Assets section of classified balance sheet. Think it through. Current and non-current assets. Visit the Apple Inc. annual report for 2020 and locate the company's balance sheet. The balance sheet begins on page 33. What types of current assets does the company have? What types of non-current assets does it have? How has the total of each type of asset changed over time? We've covered the asset side of the accounting equation. Now let's turn our attention to the other side of the equation and the other two sections of the balance sheet: liabilities and equity. Just like the assets section, the liabilities section is broken down between current and non-current. Current liabilities are those that will be due within a year. Common examples of current liabilities include accounts payable, wages payable, and unearned revenue. Non-current liabilities are those that are due more than a year into the future. Notes payable is a common non-current liability. Clear Lake Sporting Goods has accounts payable and has collected payments from a few customers that it hasn't yet shipped its product to unearned revenue. It also owes money on a note payable. Its accounts payable and unearned revenue are both current liabilities. The note payable is not due for several years, thus making it a non-current liability. See Figure 5.8. Comparative year-end balance sheet of Clear Lake Sporting Goods showing the liability section of classified balance sheet for the current and prior year. On the balance sheet, accounts payable and unearned revenue are listed first under the current liabilities header and summed to calculate total current liabilities. In a separate section under non-current liabilities, notes payable is listed, and that figure is added to the total current liabilities amount to derive total liabilities in the last row. Figure 5.8 Liability section of classified balance sheet. Think it through. Current and non-current liabilities. Visit the Apple Inc. annual report for 2020 and locate its balance sheet. The balance sheet begins on page 33. What types of current and non-current liabilities does the company have? How has the total of each type of liability changed over time? The stockholders' equity section of the balance sheet for corporations contains two primary categories of accounts. The first is contributed capital, which is funds paid in by owners. The second category is earned capital, which is funds earned by the corporation as part of business operations. On the balance sheet, retained earnings is a key component of the earned capital section, while the stock accounts such as common stock, preferred stock, and additional paid-in capital are the primary components of the contributed capital section. Clear Lake Sporting Goods has just one contributed capital account, common stock, and one earned capital account, retained earnings. The equity section of its balance sheet is shown in Figure 5.9. Comparative year-end balance sheet of Clear Lake Sporting Goods showing stockholder equity for the current and prior years. Total stockholders' equity is calculated by adding the values for common stock and ending retained earnings. This number is then added to the total liabilities that was calculated in Figure 5.8 to determine the total liabilities and stockholder equity. Figure 5.9 Stockholders, equity section of classified balance sheet. Think it through. Assets, liability, and equity. Visit the Apple, Inc. Annual Report for 2020 and locate the company's balance sheet. The balance sheet begins on page 33. What is the amount of the company's total assets for the most recent year? What is the amount of its total liabilities and equity? Importance of the balance sheet. Now that we have gone to all the work to carefully assemble a classified balance sheet, what do we use it for? The answer lies within the accounting equation itself. Think of the accounting equation from a sources and claims perspective. Under this approach, the assets, items owned by the organization, were obtained by incurring liabilities or were provided by owners. Stated differently, every asset has a claim against it, by creditors and/or owners. The balance sheet shows us what the firm has its assets, who owns them equity, and who the firm owes its liabilities. Limitations of the balance sheet. The balance sheet is indeed a very helpful financial statement, but it also poses challenges. First, assets on the balance sheet, under Generally Accepted Accounting Principles, GAAP, are recorded at historical cost. Historical cost is simply the cost paid for the item at the time it was purchased. Changes in market value of big-ticket items like land or buildings are not reflected in the balance sheet. Land remains at historical cost, and depreciable items like buildings are reflected at their current book value. Historical cost, less accumulated depreciation. If the asset has appreciated over time, the higher market value of the assets would not be seen on the balance sheet. Estimates are another limitation of the balance sheet. Items on the balance sheet, such as allowance for doubtful accounts and allowance for bad debt, are based on estimates. The useful lives for calculating depreciation is another common estimate. If these estimates are incorrect, the net value of the asset can be under or overstated. Another key limitation is the fact that a balance sheet reflects balances at only one given point in time. This means that the account value could have been quite different on the day before or the day after the date of the balance sheet. For example, if a firm were concerned with certain ratios or investor-lender expectations of its cash balance, it could choose to not pay several vendor payments in the last week of December. Thus, on December 31, the firm reflects a high cash balance on its balance sheet. However, by the end of the first week of January, it has caught up on late vendor payments and again shows a low cash balance. Finally, there are many possible things of value that are not recorded on the balance sheet. Internally generated assets and the firm's human capital are two common examples. Internally generated assets can be anything from a website, a process, to an idea. Learning outcomes by the end of this section, you will be able to identify connected elements between the balance sheet and the income statement, differentiate between expenses and payables, net income and retained earnings as mentioned earlier. The financial statements are linked by certain elements and thus must be prepared in a certain order. The income statement was first since net income, or loss, is a required figure in preparing the balance sheet. During the period close process, all temporary accounts are closed to the income summary account, which is then closed to retained earnings. All revenue and expense accounts are closed since they are temporary. The net result is either net profit or net loss as the balance in the income summary account. Remember that the retained earnings account reflects all income the firm has earned since its inception less any dividends paid out to shareholders. Thus, the result, net income, of the income statement feeds the retained earnings account on the balance sheet. Retained earnings is also an element of the statement of stockholders' equity, which we will cover later in this chapter. In Figure 5.10, we see net income in the current year of $35,000, which was added to the company's prior year retained earnings balance of $15,000. Notice, however, that the prior year balance was $15,000, and the current year balance is only $20,000. It does not total $50,000 as we might have expected. Remember, retained earnings represents all earnings since inception less any dividends paid out. Clear Lake Sporting Goods must have paid out $30,000 in dividends in the current year. We will see this information laid out in the statement of retained earnings. In the prior year, they began with a $10,000 balance in retained earnings. Income of $30,000 increased retained earnings, and dividends paid back out to investors reduced retained earnings, leaving an ending balance in the prior year of $15,000. This rolls over and is the beginning balance for the current year. In the current year, Clear Lake had net income of $35,000 and paid $30,000 of their earnings out to shareholders, essentially resulting in a $5,000 increase to the retained earnings account. Statement of retained earnings for Clear Lake Sporting Goods for the current and prior year. The ending retained earnings of $15,000 on Deck 30, 1 of the prior year, is the beginning retained earnings balance on Jan. 1 of the current year. Figure 5. 10 Statement of retained earnings. Now we can see the full flow of information from the income statement to the statement of retained earnings. Figure 5.10, and finally to the balance sheet. Clear Lake's net income flows from the income statement into retained earnings, which is reflected on the statement of retained earnings. The balance in retained earnings is then reflected on the balance sheet. This flow is depicted in Figure 5.11. Connections between Clear Lake Sporting Goods, balance sheet, and income statement. Clear Lake's net income flows from the income statement into the statement of retained earnings. The ending retained earnings flows from the statement of retained earnings to the comparative year-end balance sheet. Figure 5.11 Connections between Clear Lake Sporting Goods, balance sheet, and income statement link to learning Apple's income statement and balance sheet. Visit the Apple, Inc. Annual Report for 2020 and locate the company's income statement and balance sheet. They begin on page 31. What is the company's net income for the most recent year? What is the amount of retained earnings on the balance sheet for the current and prior years? Does it appear the company paid out dividends this year? Expenses versus payables. There is another key relationship between the income statement and the balance sheet can often be confusing to non-accountants. An expense versus a payable. The two are often assumed to be the same thing. However, it is important to note that the two are distinctly different. Let's look at an example to outline the key differences. Clear Lake Sporting Goods incurred utility expenses during the current period, electric and gas. Its utilities totaled $1,500. In the month that followed, the utilities vendor sent an invoice for $1,500. Clear Lake has incurred an expense. It will reflect an expense of $1,500 on the income statement for the utilities expense. This is the income statement impact of the transaction. So is it safe to assume that because Clear Lake has an expense, it also used cash? Not necessarily. Or is it safe to assume that if the company has an expense, it is the same as a payable? Again, the answer is no. Remember, the accounting equation rests on the foundation of the double entry accounting system. This means that every transaction has two sides, a debit and a credit. They must be equal. When Clear Lake records an expense of $1,500, it must also record the other half of that transaction. In this case, the company incurred utilities expenses throughout the period on account, which means it records an increase in their accounts payable. When the invoice comes due, another transaction must then be recorded to reduce accounts payable and reduce cash. Accounts payable is a liability found on the balance sheet, normally a current liability. The expense incurred caused the payable, but it is distinctly separate from the payable. See Figure 5.12. Connections between Clear Lake Sporting Goods expenses and accounts payable. It shows that there is a relationship between the utility expense of $1,500 from the income statement and the accounts payable from the balance sheet. Figure 5.12 Connections between expenses and accounts payable. Learning outcomes. By the end of this section, you will be able to explain the concept of owner's equity, outline the purpose and importance of the statement of owner's equity, Identify the structure and key elements of the statement of owner's equity. What is equity? Recall that the accounting equation can help us see what is owned, assets, who is owed, liabilities, and finally who the owners are, equity. The statement of owner's equity addresses the last segment of the accounting equation in detail by laying out the equity elements of the firm and highlighting changes in these elements throughout the period. Equity represents the ownership of the firm. The stockholders' equity section of the balance sheet for corporations contains two primary categories of accounts. The first is paid-in capital or contributed capital, consisting of amounts paid in by owners. The second category is earned capital, consisting of amounts earned by the corporation as part of business operations. On the balance sheet, retained earnings is a key component of the earned capital section, while the stock accounts such as common stock, preferred stock, and additional paid-in capital are the primary components of the contributed capital section. Common stock represents ownership in the firm. Common stockholders normally have voting rights. Preferred stock has unique rights that are preferred, or more advantageous, to shareholders than common stock. Unlike common stockholders, preferred shareholders typically do not have voting rights and do not share in the common stock dividend distributions. Instead, the preferred classification entitles shareholders to a dividend that is fixed, assuming sufficient dividends are declared. Treasury stock is shares that were outstanding and have been repurchased by the firm but not retired. Thus, they are still issued, but not outstanding. Additional paid-in capital is the difference between the issue price and par value of the common stock. For example, if a firm issued and sold stock at a market price of $20 that had a $5 par value, $5 for each share would be recorded into common stock, and the excess $15 per share would be recorded into the additional paid-in capital account. If we review the balance sheet for Clear Lake Sporting Goods, we see just two elements of equity: common stock and retained earnings. Common stock in the prior year was $75,000 and increased to $80,000 in the current year, indicating Clear Lake issued additional common stock. See Figure 5. 13. Clear Lake Sporting Goods, stockholder equity section of balance sheet. The total liabilities and stockholder equity has grown from $200,000 in the previous year to $250,000 in the current year. Figure 513, stockholder equity section of balance sheet. Think it through equity accounts. Visit the Apple, Inc. annual report for 2020 and locate the company's balance sheet. It begins on page 33. What types of equity accounts does it report? Distributions to owners. When firms earn a profit, they have two options as to what to do with their earnings. They can keep, retain them, and reinvest them back into the business, or they can pay them out to their shareholders in the form of dividends. Dividends are commonly in the form of cash, but dividends can be paid out in the form of stock or other assets as well. To pay a cash dividend, the firm must have enough cash on hand and sufficient retained earnings. They cannot pay out a dividend beyond the retained earnings available. Some companies issue shares of stock as a dividend rather than cash or property. This often occurs when the company has insufficient cash but wants to keep its investors happy. When a company issues a stock dividend, it distributes additional shares of stock to existing shareholders. A property dividend occurs when the firm pays out dividends in the form of something other than stock or cash, often one of their assets or something they hold in inventory. For example, Walt Disney Company may choose to distribute tickets to visit its theme parks. A property dividend may be declared when a company wants to reward its investors but doesn't have the cash to distribute, or if it needs to hold on to its existing cash for other investments. Remember, the retained earnings account reflects the cumulative earnings of a firm since they began business, less dividends paid out to shareholders. This includes all forms of dividends: cash, stock, and other assets. Note that dividends are distributed or paid only to shares of stock that are outstanding. Treasury shares are not outstanding, so no dividends are declared or distributed for these shares. Regardless of the type of dividend, the declaration always causes a decrease in the retained earnings account. Think it through dividends. Visit the Apple, Inc. annual report for 2020. Review the notes to the financial statements found on pages 19 and 20. What kind of dividends did the company pay cash, property, stock. Review the notes regarding dividends on page 26. What does Apple intend to do regarding dividends in the future, pending board approval? Elements of the statement of owner's equity. Now that we have covered the basic elements of equity and know what dividends are, we have the basic pieces we need to create the statement of owner's equity. The statement is broken out into columns, one for each element of equity: common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stock. The first line of the statement provides the balance of each segment as of the first day of the period. Each following line provides information on any events during the period that changed the value of any of the accounts. Common examples of events found on the statement include net income or loss for the period, issuing common or preferred stock, purchasing or selling treasury stock, and declaring a dividend. Clear Lake Sporting Goods has just common stock and retained earnings to report in their statement of owner's equity. They had just two events to report in their statement that impacted their equity accounts. They reported net income and they issued dividends. See Figure 5.14. Statement of stockholder equity for Clear Lake Sporting Goods. For common stock, the statement shows a beginning balance of $75,000. There is no net income or dividends paid to shareholders for common stock, but an additional $5,000 of common stock was issued. The ending balance of $80,000 is calculated by adding the amounts for beginning balance and common stock issued. Clear Lake Sporting Goods has no additional paid-in capital. For retained earnings, the beginning balance is $15,000. Net income is $35,000 and $30,000 in dividends were paid to shareholders. To calculate the ending balance of $20,000 for retained earnings, add the amounts for the beginning balance and net income, and then subtract the amount of dividends paid to shareholders. Clear Lake Sporting Goods has no treasury stock. Totals for each line item, beginning balance, net income, dividends paid to shareholders, common stock issued, and ending balance are calculated. The total ending balance on this statement is $100,000. Figure 5.14 Statement of Stockholder Equity for Clear Lake Sporting Goods. Link to Learning Cash Flows. Khan Academy explains cash flows in a unique way. Learning outcomes. By the end of this section, you will be able to outline the purpose and importance of the statement of cash flows, identify the structure and key elements of the statement of cash flows. The final financial statement is the statement of cash flows. It is a crucial statement as it shows the sources of and uses of cash for the firm during the accounting period. Remember, under accrual accounting, transactions are recorded when they occur, not necessarily when cash moves. Thus, the income statement does not provide all the insights necessary to understand a firm's cash flows. To fully understand the firm's flow of cash, the statement of cash flows is needed. Importance of the statement of cash flows. Remember, most firms use accrual accounting. Revenues and expenses are recorded when they occur, not necessarily when cash moves. This can create timing differences between profits and cash flows. A firm can be profitable and still not have an adequate flow of cash. The opposite is also true. It can experience a net loss and still have cash on hand. Earning a profit is wonderful, but it is not the only goal an organization has. It must also have adequate cash flow to support daily operations. To support cash planning and to provide external financial statement users, such as lenders and investors, information about the firm's cash flow, the statement of cash flows is prepared. Cash flow is also a crucial metric for determining the value of a company. External financial statement users also rely on the statement of cash flows to help them evaluate the quality of the firm's earnings. Users compare earnings to cash flow to assess the validity of the earnings data. For example, a firm reporting a strong profit but very little cash flow might raise some questions as to what was recorded to drive profits that isn't also driving cash flows. The statement of cash flows also helps external users determine the driving forces behind the firm's cash flows. They can see if cash is generated primarily by daily operations or if cash is being generated or consumed by events outside the firm's normal course of business. There are two key methods of preparing the statement: direct and indirect. FASB, Financial Accounting Standards Board favors the direct method. Despite that, the most common method used by far in general practice is the indirect method. The direct method lists cash flows directly from revenues and expenses, whereas the indirect method reconciles income to cash flows. The indirect method begins with net income and reconciles each account in order to arrive at net cash flow. It essentially reconciles accrual basis accounting to cash basis, or cash flow. Operating activities to provide clear information about what areas of the business generated and used cash. The statement of cash flows is broken down into three key categories: operating, financing, and investing. The operating section reflects cash flows generated by and used by the day-to-day operations of the business. Investing activities include investments in other firms as well as investments in the firm itself, items like machinery, land, or other fixed assets. Finally, financing activities are those used to provide funds to run the business: loans, interest. As mentioned, operating activities are those that are used or generated by the day-to-day operations of the firm. The operating activities section of the statement of cash flows begins with net income. All lines thereafter in that section are then adjustments to reconcile net income to actual cash flows by adding back non-cash expenses like depreciation and adjusting for changes in asset and liability accounts. For example, depreciation is a non-cash expense. Thus, depreciation is added back to net income. To prepare the statement of cash flows for Clear Lake Sporting Goods, we need the beginning cash balance from the balance sheet, net income and depreciation expense from the income statement, and a set of comparative balance sheets to see the change in asset and liability accounts. See Figure 5. 15. Comparative income statements and balance sheets for Clear Lake Sporting Goods. On Clear Lake Sporting Goods' comparative year-end income statement, the current year depreciation expense and net income figures are highlighted. On the company's comparative year-end balance sheet, the following figures are highlighted for both the prior and current year. Current assets, which in this example includes cash, accounts receivable, inventory, and short-term investments. Non-current assets, which includes equipment. Current liabilities, in this case, accounts payable and unearned revenue. Non-current liabilities, which only includes notes payable, and common stock under total and stockholders' equity. Figure 5.15 Comparative income statements and balance sheets Clear Lake statement of cash flows begins with the current year net income of $35,000 from the income statement. Next, non-cash expenses are deducted. Clear Lake's only non-cash expense on their current year income statement is depreciation of $3,600. Since depreciation is an expense that reduces income but is not actually paid out in cash in the current period, it must be added back to net income to reconcile net income to cash flow. Next, changes in operational assets and liabilities are used to continue reconciling net income to actual cash flow. For example, Clear Lake's accounts receivable increased from the prior period to the current period. This means that there were more sales recorded, but not yet received in cash in this period than there were in the prior period, making an increase in accounts receivable a reduction on the statement. Inventory increased, which means additional cash was spent to acquire it, making it a use of cash or reduction to net income to move closer to cash. Accounts payable and unearned revenue, both liability accounts, increased. Since these are liabilities, an increase would indicate that the liability was incurred but not as quickly paid out. Thus, it is an increase to the statement. Tallying all these adjustments to net income shows Clear Lake's net cash flows provided by operating activities of $53,600. See Figure 5. 16. Operating activities section of the statement of cash flows for Clear Lake Sporting Goods. The net cash flow from operating activities is $53,600. Figure 5. 16. Operating activities section of the statement of cash flows investing activities as mentioned. Investing activities include investments in other firms as well as investments in the firm itself, items like machinery, land, or other fixed assets. These are items that are capitalized, placed on the balance sheet, and depreciated over time, and thus did not reduce net income. They did, however, Cause and impact to cash flow, see Figure 517. During the current year, Clear Lake purchased an additional $5,000 in short-term investments. See the comparative balances sheets. The balance in that account increased by $5,000 since the prior year. They also purchased additional plant assets in the amount of $13,600. This amount can be figured by comparing the difference in the current and prior plant assets accounts and including the impact of current year depreciation. $50,000 current year balance less $40,000 prior year balance and $3,600 of depreciation equals $13,600 of new assets purchased. Investing activities section of the statement of cash flows for Clear Lake Sporting Goods. Because of the purchase of short-term investments and the cost of new plant assets, the net cash flow from investing activities is negative $18,600. Figure 5.17 Investing activities section of the statement of cash flows financing activities. Recall that financing activities are those used to provide funds to run the business. Common items in this section of the statement include the payment of dividends, issuance of common or preferred stock, and issuance or payment of notes payable. See Figure 518. In the current year, Clear Lake took out additional notes payable, a cash inflow. We can see this by the increase in their notes payable account from the prior year to current year, $40,000 to $50,000. This is an inflow of cash and thus an increase on the statement. Dividends of $30,000 were paid to shareholders, found on the statement of retained earnings and the statement of owner's equity. Finally, we see that Clear Lake must have issued additional common stock, as their common stock balance increased from $75,000 to $80,000. Financing activities section of the statement of cash flows for Clear Lake Sporting Goods. The net cash flow from financing activities is negative $15,000. Figure 5.18 Financing activities section of the statement of cash flows. Link to Learning Statement of Cash Flows. Visit the Apple Inc. Annual Report for 2020 and locate the company's statement of cash flows. It begins on page 35. What is the cash provided by used by operating activities? Review the key adjustments in the operating section. What are the biggest adjustments? Review the investing section of the statement. Did the company have a net cash inflow or net cash used by investing? What key items appear in this section? What was the net cash provided by or used by financing activities? What key items appear in this section for Apple? The final task to wrap up the statement of cash flows is to tally net cash generated or used by summing all three sections. This amount is then used to adjust the beginning cash balance from the balance sheet. Assuming the statement was prepared correctly, the sum should equal the ending cash balance on the balance sheet. In the full statement, we can see that Clear Lake has net cash flow of $20,000. The beginning cash balance was $90,000, making the ending cash balance $110,000. See Figure 519. Full statement of cash flows for Clear Lake Sporting Goods. Clear Lake has net cash flow of $20,000. The beginning cash balance was $90,000, making the ending cash balance $110,000. The net cash flow figure was found by calculating the net cash flow from operating activities, $53,600, and subtracting the cost of investing activities, $18,600, and the cost of financing activities, $15,000. Figure 5.19 Full statement of cash flows. Analyzing performance. The statement of cash flows can be used in a number of ways to assess firm performance by both internal and external financial statement users. Internal users can assess sources of and uses of cash in order to aid in adapting, as necessary, to ensure adequate future cash flows. External users also use the statement. Recall that comparing net income to operational cash flows can help assess the quality of earnings. In the next section, you'll explore operating cash flow and free cash flow to the firm, two key points of analysis in assessing cash flows. Learning outcomes. By the end of this section, you will be able to calculate operating cash flow and free cash flow, assess organizational cash management performance, operating cash flow. Now that we have a statement of cash flows prepared, We can move on to a few key elements of the statement used to assess organizational cash management performance. Operating cash flow, or net cash flow from operating activities, is calculated in the first section of the statement of cash flows. It depicts the cash generated or used by the primary business activities. Remember, operating cash flow is calculated under the indirect method by adjusting net income for non-cash expenses like depreciation and adjustments for changes in current asset and liability, accounts, changes in net working capital. Operating cash flow equals operating income plus depreciation minus taxes plus change in net working capital 5. 6. Operating cash flow is helpful in assessing organizational cash management performance as it relates to the core business function, operations. Key management practices in this area can have a profound impact on the firm's cash flow. Practices and policies include customer payment terms, collection policies and practices, and vendor payment terms. Though changing a customer or vendor payment terms will not change the profit or loss for the firm, it will have an impact on the timing to cash flows. This is a key element of managing operational cash flow. Free cash flow, FCF, is calculated by taking operating cash flows less capital expenditures. Free cash flow is an important measure, as it depicts the cash available to support the business's operations and maintain its fixed assets. It is commonly used by investors as part of their overall evaluation of an investment, as it is a key measure of cash flow management practices and a firm's ability to generate enough cash to cover operations and capital assets. And it shows if there is any left over for other considerations, such as dividend payments, debt repayment, and contributions to increase working capital for future growth. Free cash flow, FCF, equals operating cash flow minus capital expenditures 5. 7. Using the data for Clear Lake Sporting Goods, we can calculate its free cash flow as follows. Free cash flow, FCF, equals $53, 600 minus $13, 600 equals $40, 0005. 8. This means that Clear Lake Sporting Goods has $40,000 of cash available to repay debt or pay cash dividends after having covered the cash needs of its operations and capital asset investments. Managing cash flow is not an easy task. A firm has a myriad of places that its cash flows from or to. However, there are a few key areas to place attention in order to manage or improve cash flows. First, consider where cash is coming from customers. Managing terms and collection efforts with customers can have a significant impact on a firm's cash flow. For example, a customer with terms of net 10 will likely yield payment quite quickly, 10 days, give or take. A customer with terms of net 60, on the other hand, will require roughly 60 days to collect assuming they pay on time. The 50-day difference between these two examples means that the firm will go 50 additional days having expended the resources to provide the customer their good or service, but with no cash flow yet to cover it. The same theory holds true on the opposite side with accounts payable and the vendors a firm uses. Accepting net 10 terms requires the firm to give up its cash quickly, while pushing for more favorable terms like net 30 or net 60 allows the firm to wait much longer to give up its cash. It is important to assess both sides of cash flow and the impact it has on the firm, as well as the customer and vendor relationships it maintains. Some customers may not have difficulty negotiating a more favorable payment term in order for the firm to improve its cash flow. Others, however, may not be willing to accept shorter payment terms. In order to be competitive in the industry, the firm must assess the customer relationships, industry standards, and its own ability to support cash flow when considering its customer payment terms. When there is a gap in cash flow, it is crucial that it is recognized early, with proper cash flow forecasting, so financing can be obtained to bridge the gap. A common tool used to manage the ebb and flow of cash flow for a firm is an open line of credit with a bank. This allows the firm to borrow and repay from month to month as cash flow fluctuates. Now that you've become more familiar with the 4 basic financial statements, let's move on to a tool helpful in evaluating them. Common size statements. Common size financial statements, also termed vertical analysis, restate the financial statement items as a percentage of a base item. Doing so helps reveal relationships between items, aids in assessing performance over time, and makes it easier to compare one company to another, regardless of size, thus the name common size. Learning outcomes. By the end of this section, you will be able to prepare common size statements, assess organizational performance using common size statements, use industry comparisons to assess organizational performance, common size income statements. A common size income statement is created by restating each line as a percentage of net sales. Expressing each item on the income statement as a percentage rather than in absolute dollars makes it much easier to make comparisons, particularly to other divisions or competitors of varying sizes. The formula to calculate each item on the income statement is common size item equals income statement line item, net sales, 59. Using Clear Lake Sporting Goods, current year income statement, we can see how each line item in it is divided by net sales in order to assemble a common size income statement. See Figure 5. 20. Common size income statement for Clear Lake Sporting Goods showing the current year's income, current year percentage, and formula. The net income is $35,000, is about 29% of the net sales. This was calculated by dividing 35,000 net income by 120,000 net sales. Figure 520 common size income statement. It may seem cumbersome to create a common size statement. However, a simple tool like Microsoft Excel can be quite handy in making the process easier and faster. The same formula can be copied and replicated in each income statement line, making the calculations much faster. In Figure 521, you can see the formulas used to create Clear Lake Sporting Goods common size income statement in Excel. Notice that the dollar can be inserted to anchor a cell reference, making it easier to copy and paste the same formula onto many lines or columns. Clear Lake Sporting Goods common size balance sheet with Excel formulas. The Excel formula used to determine percentages is equals B/B$11. In this formula, the first cell reference after the equals sign represents the dollar amount for the line item you are working with. B$11 represents the total assets. Figure 5. 21. Clear Lake Sporting Goods common size income statements with Excel formulas. Common size balance sheet. The common size balance sheet functions much like the common size income statement. Each line item on the balance sheet is restated as a percentage of total assets. Common size item equals balance sheet line item, total assets, 510. Using Clear Lake Sporting Goods current balance sheet, we can see how each line item in its statement is divided by total assets in order to assemble a common size balance sheet. See Figure 5. 22. Comparative year-end balance sheets for Clear Lake Sporting Goods shows the current year amounts, current year percentage, and formula for assets, liabilities, and stockholder equity. For example, accounts receivable, $30,000, is divided by the total liabilities and equity figure, $250,000, to derive 12% of the current year's total. Figure 5. 22. Common size balance sheet. Excel can also be used to create a common size balance sheet. Once the formula is created, it can be copied into each line, making the process to create a common size statement much easier. See Figure 5. 23. Clear Lake Sporting Good common size balance sheet with Excel formulas. It shows the percentage figures of various assets and liabilities against the total assets and total liabilities. Figure 5. 23. Common size balance sheet with Excel formulas. It is important to note that while we have provided 2 years of data here to explore the process, when performing analysis for a firm or investment, several years of data are commonly used to provide a better view of historical performance. Analyzing organizational performance. Common size financial statements facilitate the analysis of financial performance by converting each element of the statements to a percentage. This makes it easier to compare figures from one period to the next, compare departments within an organization, and compare the firm to other companies of any size as well as industry averages. On the income statement, analysts can see how much of sales revenue is spent on each type of expense. They can see this breakdown for each firm and compare how different firms function in terms of expenses, proportionally. They can also look at the percentage for each expense over time to see if they are spending more or less on certain areas of the business, such as research and development. On the balance sheet, analysts commonly look to see the percentage of debt and equity to determine capital structure. They can also quickly see the percentage of current versus non-current assets and liabilities. In Clear Lake Sporting Goods, common size income statement for the current and prior years, we can see that cost of goods as a percentage of sales remained the same. See Figure 524. This means that while sales increased, so did cost of goods sold, but it increased at the same proportion as sales. No improvement or decline occurred in the company's cost of goods sold. The same is true for rent, depreciation, and utilities expenses. One key item did change slightly as a percentage: salaries expense. The 2% decrease in operating income from the prior year's 38% to the current year's 36% was caused by the increase in salaries expense as a percentage of sales. Net income, however, only declined by 1% from 30% in the prior year to 29% in the current year, because interest expense dropped by 1%, offsetting the 2% increase in salaries expense. Common size income statement for Clear Lake Sporting Good. It shows the percentage figures of various assets and liabilities against the total assets and total liabilities for the prior and current years. The percentage for most items remained the same year over year. However, the salaries expense rose, both in dollars and percentage. In the prior year, salaries expense was $3,000, representing 3% of the prior year. In the current year, salaries expense is $5,400, representing 5%. Figure 524 Common Size Income Statement. Link to Learning. Common Size Income Statement. Visit the Apple Inc. Common Size Income Statement provided by the Stock Analysis on Net website. Review the company's cost of sales, gross profit, operating income, other income, and net income percentages for the current and prior year. What can you learn about the company's recent performance in these areas? Has it improved or declined, or has it simply changed incrementally with gross sales? On the Clear Lake Sporting Goods common size balance sheet, we see that current assets remained at 80% of total assets from the prior to current year. See Figure 525. The mix of current assets that comprise that 80% changed only slightly, with a 1% decrease in cash, 2% increase in accounts receivable, 2% decrease in inventory, and no change in short-term investments. Non-current assets includes only equipment. While the balance in the equipment account did change as a percentage of total assets, equipment remained the same at 20%. On the debt and equity side of the balance sheet, however, there were a few percentage changes worth noting. In the prior year, the balance sheet reflected 55% debt and 45% equity. In the current year, that balance shifted to 60% debt and 40% equity. The firm did issue additional stock and showed an increase in retained earnings, both totaling a $10,000 increase in equity. However, the equity increase was much smaller than the total increase in liabilities of $40,000. Long-term debt increased by only $10,000 by issuing additional notes payable. The remainder of that increase is seen in the 5% increase in current liabilities. In that increase, most of it was in unearned revenue. Common size balance sheet for Clear Lake Sporting Goods. For each line item, it shows what percentage of total assets and total liabilities that line item represents for the prior and current years. For example, in the prior year, total liabilities were $110,000 or 55%. In the current year, total liabilities were $150,000 or 60%. Figure 525 Common Size Balance Sheet. Link to Learning. Common Size Assets and Common Size Liabilities and Equity. Visit the Apple Inc. Common Size Assets Balance Sheet and Common Size Liabilities and Equity Balance Sheet provided by the Stock Analysis on Net website. Review the composition of the company's assets, liabilities, and equity. How have assets changed? Has capital structure changed? If so, what elements impacted the change? Industry comparison. Recall that a key benefit of common size analysis is comparing the firm's performance to the industry. Expressing the figures on the income statement and balance sheet as percentages rather than raw dollar figures allows for comparison to other companies regardless of size differences. Clear Lake Sporting Goods, for example, might compare their financial performance on their income statement to a key competitor, Charlie's Camping World. Charlie is a much bigger retailer for outdoor gear, as Charlie has nearly 7 times greater sales than Clear Lake. Common size statements allow Clear Lake to compare their statements in a meaningful way, see Figure 526. Notice that Clear Lake spends 50% of its sales on cost of goods sold, while Charlie spends 59%. This is a significant difference that would be an indicator that Clear Lake and Charlie have key differences in their operations, purchasing policies, or general performance in their core products. We know that Charlie is a bigger retailer, and we see this clearly in the rent expense as a percentage of sales. Charlie spends 11% of its sales on building rent, while Clear Lake spends only 5%. A clear difference in performance is hinted at here, alluding to Charlie spending more per square foot on rent or using its retail space differently, causing it to rent more space for its product per sales dollar than Clear Lake does. Depreciation expense, though not a large figure, is smaller for Charlie, giving us a hint that Charlie has less capital equipment than Clear Lake, perhaps tied to the higher rent expense. It is possible that Charlie rents some of its equipment, which would help explain the higher rent percentage. Finally, Charlie's salaries percentage is significantly higher at 12% than Clear Lake's 5%. Though the simple percentage does not tell us why, it does provide us a hint and allow for further questions or investigation. Charlie may pay its employees a much higher wage than Clear Lake. They may also have far more sales associates on the floor in their larger spaces than Clear Lake does in their smaller retail spaces. Note that although we have compared just 2 years of data for Charlie and Clear Lake, it is more common to use several years of data to get a more robust view of long-term trends. Charlie's Camping World and Clear Lake Sporting Good comparison of common size income statements. It shows the percentage figures of various assets and liabilities against the total assets and total liabilities for the prior and current years. Clear Lake spends 50% of its sales on cost of goods sold, while Charlie spends 59%. Charlie spends 11% of its sales on building rent, while Clear Lake spends only 5%. Depreciation expense is smaller for Charlie. Charlie's salaries percentage is higher at 12% than Clear Lake's 5%. Figure 5.26 Comparison of common size income statements. Link to learning. Microsoft versus Apple. Locate the sales, cost of goods sold, and gross profit data for Microsoft's most current period using Yahoo. Finance. Calculate the common size percentage for cost of goods sold and gross profit, cost of goods sold divided by net sales, and gross profit divided by net sales. Compare these percentages to those of Apple Inc., a key competitor, on its common size income statement. What can you learn about the performance of each firm based on these two percentages? Now that you have covered the basic financial statements and a little bit about how they are used, where do we find them? How often are they prepared? Who gets them? In this next section, we will explore the requirements for what needs to be reported, when, and to whom. Learning outcomes. By the end of this section, you will be able to identify the most common types of accounting periods, outline key considerations and accounting principles that dictate the timing of financial reporting, describe the SEC reporting requirements relevant to financial statements, identify the key elements of a company annual report, defining accounting periods. An accounting period can be any period of time, but the most common accounting periods are months, quarters, and a year. Accounting periods are important, particularly in accrual accounting, so there are clear cutoffs for recording transactions. It is important to note that generally accepted accounting principles, GAAP, require companies to provide quarterly financial statements. However, most firms, even those not covered by GAAP, prepare financial statements monthly in order to provide timely data to their financial statement users both internally and externally. Time period principle. Providing information to financial statement users in a timely fashion brings us to our next key topic, which is the time period principle. In order for information to be useful, it must be timely. This means that financial statement users need to get the statements quickly enough to be able to make relevant decisions with them. Providing statements on a timely basis is the foundation of the time period accounting principle. Fiscal versus calendar year. Though a firm may present financial statements monthly, quarterly, and annually, not all time periods are created equal. Firms have the option to choose between a fiscal and a calendar year. The calendar year, which begins January 1 and ends December 31, is the traditional year we are accustomed to. The calendar year, however, doesn't always work well with a firm's business cycle. Due to seasonality or other factors, a firm may choose to adopt a fiscal year with their own beginning and end date. For example, a firm may choose to start its fiscal year on June 1 and end it on May 31. A firm can opt to change from a fiscal to a calendar year or vice versa, but must only do so for a justifiable reason. Think it through. Fiscal versus calendar year. Visit the Apple Inc. Annual Report for 2020 and review the title of the table of contents on page 1. The title reads, Apple Inc. Form 10-K. The next line provides information on the company's chosen time period. Does Apple use a fiscal or calendar year? The annual report. An annual report is part of the 10-K filing that publicly traded firms must provide to the SEC and investors each year. The report details the firm's operations and performance for the year and its current financial conditions. The report contains general company information, the firm's financial statements, notes to the financial statements, various required disclosures pertaining to accounting policies, the management discussion and analysis, MD&A statement, a letter from the CEO to the shareholders, and the firm's audit report. Think it through. Annual report key elements. Visit the Apple Inc. Annual Report for 2020 and review the title of the table of contents on page 1. What key elements would you be drawn to review if you were a potential investor? In Part II of the table of contents, find the MD&A report, page 20, and use the table of contents link to navigate to it. What key highlights and challenges did the company report for the year? SEC reporting requirements. The Securities and Exchange Commission, SEC, requires publicly traded firms to regularly provide several reports. The two most common are the 10-K and quarterly report, 10-Q. Certain unique events also require an additional filing called an 8-K. There are many events that might require reporting. A few key examples include changes to rights of shareholders, changes in control of the company, and amendments to the company charter or bylaws. The quarterly report is much like the annual report already discussed. It contains the firm's financial statements, required accounting disclosures, statements on internal control, and a management discussion and analysis, MD&A letter. It does not contain an auditor's report, as firms are not audited on a quarterly basis. Quarterly reports are helpful to investors because they provide information on a timely enough basis to be relevant. Link to learning. Investor relations. Visit the Apple Inc. Investor Relations page, SEC Filings section. Notice how many different reports Apple files regularly with the SEC. Locate the most recent quarterly, 10-Q, and annual reports, 10-K, and scan the table of contents. How does the quarterly report differ from the annual report? Do you notice key items in the annual report not provided in the quarterly report?